Investing your money in 2022 investment tips for beginners Thousandaire Club. I presume that this is not your first time hearing about investment, and I just want to ask you this question: do you have any investment? In today's video, we shall be taking a look at the best investment ways of investing your money in 2022. We shall unveil some useful investment tips that you would need just in case you are new to investment opportunities and processes. But before we dive right into this video, make sure that you like the video, hit the notification bells so that you will be informed each time a new video is uploaded, and also subscribe to this channel if you haven't, and do not hesitate to leave a comment. Investment is indeed the smartest and surest way to a life of financial freedom for you, but you must be very certain of the kind of investment that you make. You must be thoughtful about it. If your friends benefit from a particular investment, it doesn't mean that you too will benefit from it. Nevertheless, this should not discourage you from investing. First and foremost, be particular about the kind of investment you would like to partake in. Make sure that it is one you are interested in and willing to learn, and understand. If possible, hire a trained professional to put you through every part of this investment process. Then devise a plan and a strategy with a blueprint to follow pertaining the investment. It is also advisable to invest money that you do not presently have a need for and can spare for a couple of years, as well as to have a big heart to bear risk, because some investments are riskier than others. This is something you must take note of. These are some possible best ways to invest your money wisely. Number 1. Mutual funds. Mutual funds are investment opportunities that present to you several collections of stocks and bonds, including other assets, put together. This is usually a juicy offer that will be difficult for you to build and achieve if you decide to invest in these bonds and stocks individually and singly. One of such funds is the S&P 500. This consists of about 500 largest companies that are located in the US. These kinds of mutual funds are also referred to as index funds because they only attract low fees from you as the investor, and in some other cases, no fees are attached at all. This makes it possible for you to accumulate much wealth in a relatively reasonable time because the low cost translates to more fund return for you. Number 2. ETFs. Known as exchange-traded funds are quite similar to mutual funds because they are collections of securities, but differ from mutual funds because, just like stocks, they trade throughout the day. Another difference between mutual funds and ETF is that ETF is more expensive to purchase, which is the cost of one share and several fees and commissions attached to each share. But the beautiful thing about ETF is that you can invest in its fractions with the help of your broker. Number 3. Individual stocks. This is the most rewarding investment, but also the riskiest. It involves purchasing stocks from individual companies. Before you embark on this investment, you must decide if you truly want to buy stock as a long-term investment, usually for a period of 5 years and above. The patient is the watchword, as you must be willing to bear a lot of risks as you are a part owner of the company. So if you are not ready for such a long period of time before you start making a profit, make sure that you go for other alternative investment opportunities. Number 4. High-yield savings accounts. This is the simplest way of saving and investing at the same time. It is the sure way for you to gain good returns and multiply your funds. This is very different from a standard savings account, as it is an online bank and pays higher interest. This investment platform also gives you the liberty to access your money at any time. It is a perfect way to accumulate the money you wish to buy a future asset, or a way of having a reserve emergency fund that you can always fall back on. When you are thinking of investing on any investment platform mentioned above as a new investor, and then these are some vital factors that you must have at heart. Number 5. Taxes. For every dividend, interest, or capital gain that you get from investing in individual companies and joint accounts, there is always a certain tax attached, and the only way you can avoid being taxed is to other tax-advantaged investment opportunities and plans. Number 6. Financial goals. You must make sure that you have financial goals to begin with. If not, your whole effort of investment will be all wasted at long last. You must have both a short-term and a long-term goal, which should guide your investment habits and create a master plan for your investment tactics and strategies. Number 7. Active or passive. Another very important fact that you must consider before starting out as an investor is to decide if you want to be an active or a passive investor. A passive investor merely owns an asset that has low fees attached to it. Such kinds of investments include mutual funds and ETF. On the other hand, an active investor is someone who invests in individual companies and becomes the owner of individual stocks with companies whose aim is to rank the top in their market space. But from long-term results, it is discovered that passive investors tend to make more cash than active investors in the long run. So make sure you consider all these before setting out to invest. If you enjoyed this video, like it, hit the notification bell so that you would be informed each time a new video is uploaded. Also leave your comment and subscribe to this channel if you haven't. Thank you for watching.